Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show, and heaps to talk about today with the ASX, the S&P 500. Of course, we've got all the commodities as well: gold, copper, silver, uranium. Lots to go about there. And also any stock codes you'd like me to go through. Get them ready for the end of the show, and we'll go through those, see what the chart structure and the technicals look like on those. Now, of course, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into our first chart for the week. And of course, we start off with the ASX 200. And at first glance, the ASX 200 hasn't done much this week. It's finishing the week pretty much where it began. And so from that perspective, not a great deal going on. But it's what's been going on below the surface that I think is the most interesting thing to discuss. And we'll get to that in a few moments. There's also some telling developments in the S&P 500. I'm going to go through and show you a potential tailwind that almost always leads to higher levels. And I'm also going to show you what I think is the number one risk. So plenty to go through with the US market as well. But before we get to that, let's just focus in on this latest price action in the ASX 200. And prices are starting to become established above the moving averages. And you'll notice that these moving averages, they're turning higher, and they haven't quite crossed yet. So this is the 50-day moving average in red and the 100-day moving average in blue. So the 50-day is close to crossing over the 100-day, which is an important thing, and that's close to happening at the moment. Because the reason that's important is because you can't have a bullish trend without that condition being met. So you can't have a bullish trend without the 50-day average being above the 100-day average. And so I think this is an important development. We spoke about the potential of a pullback last week, and the reason was that we've seen the ASX 200 have an almost uninterrupted rally off the April low, and price has been getting stretched above the 50-day moving average. Let me quickly put on an indicator. We've looked at this over the last couple of weeks, and this just shows the extent that the current price is above the 50-day moving average. So here's 0% here, and there's 4%, which is currently around where the market has been. And then if it's below the moving average, you get a negative percentage down on that right-hand side. So what I want to do here, I'm going to also put I'm just going to run a marker across. Let me just compress that for you, and I'm going to get 4%. Run a marker across from 4%. There we go. That just about does that. So what do we have here? So the ASX 200 it's paused through the week, and that pause has let the 50-day moving average start to catch up a bit. But when we look down here at the indicator, prices are still at elevated levels relative to the 50-day moving average. Now, this often resolves in one or two ways. Either the ASX 200 keeps tracking sideways and the moving average catch up, or prices pull back towards the moving average, or maybe some sort of combination of the two. It's interesting. It's interesting to look back at past situations. So a stretched position above the 50-day moving average, it can be sustained for a while. So let's just see. So here's an example. You can see two examples here from 2022, 2023. Also, here's an example from late 2023. So you can see these elevated positions can be sustained for a while, maybe several weeks, maybe a month. But ultimately, price always comes back and reconnects with the 50-day moving average. As you can see on these occasions, prices got stretched, it stayed elevated for a while, but it did come back. Elevated, but it did come back. Over here, elevated, but it did come back in the end. So when we look at it from that perspective, I think this limits the near-term upside of the market just for the moment, and we're already seeing this play out in the equal weight. So let me just go over to the ASX 200 on an equal weight basis. And when we look at it on the equal weight, I'm just going to take that indicator off for now. When we look at this on an equal weight, unlike the ASX 200, that's traded at a recovery high on Wednesday, the equal weight, to the contrary, has been consolidating over the last week and a half. So it had its high a week and a half ago. It's been tracking sideways since. So there's been more of a pause playing out in the when we rank all the stocks from biggest to largest, weight them equally. It's been more of a sideways market over the last week and a half. And just look at the price action. So far, the pullback's been shallow, with prices essentially within a narrow trading range. And I think this is a sign that there's buying interest on the dip. So near-term support comes in. You can see this blue horizontal coming in at around 1,920, takes in some previous high points from last year, some lows from last year and early this year. So I think that's a near-term support, and that also coincides with the moving averages, which you can see coming up within that region now, and they're also turning higher, which I think is a positive. As we discussed last week, for me, it's been a process of gradually getting money back into the market over the last 6 weeks, and that's what I've been discussing in the strategy sessions with you over those last few weeks. And I think that remains the approach. Yes, the market has had a good run, and there is some potential for it to pause and pull back. But I also don't think now's the time to get carried away with getting too aggressive into the market. As I was saying, I think it's like been that case of gradually getting into the market over the last several weeks, and then also gradually adding to a portfolio as suitable opportunities appear. And of course, as we always talk about, it's that letting profits run. When you get into good positions, let them run, see where they go, use those wide trailing stops. It was interesting, just through the weeks, one of the stocks in my portfolio, it's one of the motion trader stocks as well. I had a big move yesterday and also the day before. Just quickly show you, it's this stock here, it's Catapult Group, ticker code CAT. You can see this strong uplift in the share price just in the last few days. And this is what letting profits run and wide trailing stops are all about. So we had all that volatility in the market during April, and Catapult got caught up with that too. The share price did come off from its highs. It pulled back, but the wide trailing stop kept me in this stock. It kept motion trader members in this stock as well. And the stop was somewhat below the market. It's a calculated stop. It's based on the share price volatility. So it's not guesswork, it's calculated. And so this is the advantage I think we have when we can use these calculated exit points, because it can keep us in these good stocks. Yes, there's been volatility in the market over the last couple of months, but it hasn't been a cause to sell every stock in a portfolio. Plenty of stocks like this I've continued to keep through that volatility. So I think wide trailing stops, letting profits run, really important. If you're interested in calculated trailing stops and you're not a motion trader member, there's a link below. There's free 2-week trial. Maybe come across and see what I'm doing with those wide trailing stops, because they are really useful and helpful at staying on some of these big trends and not letting volatility unnecessarily shake you out. Just coming back to the ASX 200 briefly, I think the next pullback I've said this last week, I think the next pullback tells us a lot. What I want to see the ASX 200 holding on to most of these gains, these strong gains. I want to see it holding on to most of those gains from the April low. And I think the more it can hold on to, the stronger the underlying buying interest on the dips, and that's what we want to see if this is going to develop into a sustainable up move over in the months ahead. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks. The video tells YouTube you're watching. YouTube shows other people, and that helps me a lot. So please do that. Click that like button now while you're thinking about it. And maybe a short comment. You know, what you're thinking of the market. Anything you're thinking, let me know in the comments. All right, so let's go over to the US market, S&P 500. And after an historic advance, the S&P 500, not surprisingly, is now pulling back. And this is the largest pullback in 5 weeks. But given the extent of the gains, it's really is just a mild step back at this point. We spoke about this possibility last week when prices, and the thing is, when prices rally quickly from below the moving averages to above the moving averages, we often see prices pause and consolidate. It's just typical price action that we see as prices move higher. And this is especially so when prices get stretched above the 50-day moving average. There it is there in red. There's a 50-day average, the 100-day in blue. When prices get stretched, they more often than not pause and pull back and consolidate. The key now is, what does this pullback look like? Does it quickly find support and buying interest around or not too far from current levels? Or is the rally quickly sold into and then quickly retreat? And an example of that was, like, look at this period here from 2022. So it was a strong rally, not dissimilar to what we've seen now, but rather than pausing and consolidating above the moving averages, you can see the market quickly turned and the rally was sold into. That's of course what we're looking out for. If the market doesn't hold its gains, then we start looking, is something else going to happen? So it's always being prepared for different scenarios which can play out. From a bullish perspective, as I was saying, what I want to see that shallow pullback that comes back, holds above the moving averages, and then this helps establish the S&P 500 above moving averages, and then potentially sets up the platform for higher levels. But the key is, we need to see the dip bought. We need to see the pullback being shallow. That's what sets up the potential for further moves higher. I want to show you a factor that could be a tailwind for stocks, and this is interesting. So this is the VIX the volatility index. It's called the nickname the VIX, VIX, and it's a volatility index with the S&P 500. And what I want to do, I'm going to actually put this onto a weekly so we can get some longer term perspective on this. And so this goes back to about 1990. So let me just scroll back, compress this up a bit there. So there's where this goes back to 1990. And now let me run a marker from, let's use 50. Let's use 50 as our reference point. And so this has been one of the fastest falls in volatility on record. So you can see volatility spiked up and then it's come back quickly. Other periods where volatility's run up, so this is COVID, it ran up, but then it took several months to really unwind. This is the GFC, ran up and then took several months to unwind. And then there are other periods through time where volatility has spiked. But what we have now, we have one of the fastest falls in volatility on record. And when volatility collapses in this manner, it typically doesn't make a quick comeback. So look at the past spikes above 50, which we've got. You can see from our marker. Look at those past spikes to 50 or above, with the exception of last August. So last August was only 6-7 months ago. It wasn't too long back. With that exception, all the other big spikes in volatility, just look at them. Look how far they're separated by. They're typically separated by at least 18 months to 2 years, if not more. You usually don't get two big spikes back to back. So yes, there can be flare-ups, volatility can come down and then it can tip up again, but you don't usually see a return to those past peaks. So according to the volatility index, you'd say that the main act has now passed. Volatility has come right back down, and this opens, I think what this does, I think this opens the path to further potential gains in the coming months. So people looking for a retest of the lows, history of the volatility index says that's unlikely. Anything can happen, nothing's impossible, but the odds seem to favour that even if there was a broad range play out over the next several months, that the as I say, the main act does seem to now be over. But of course, as always, we want to think about, look, let's not be blindly optimistic. Let's think about what could go wrong. And one of those things that could go wrong, which I think is important to keep an eye on, is, I'm going to show you that now. It is bond yields. So this is the US government 10-year bond yield. I've been watching this over months now, and we talked about this. Maybe we talked about this 3 or 4 weeks ago. It's worth talking about again. So it's been in this big holding pattern for about, that must be about 18 months. And see how it's just been tracking sideways. Had the big rally from the lows, and then for 18 months we've just been tracking sideways. So it's effectively a holding pattern, and it's just below this key 5% level. So you can see this blue shaded area. That marks around 5%. So let's put this onto a weekly chart so we can just see it, step back and see it in a little bit more detail. That's a bit too much detail. That's a monthly. Let me try that again. There's our weekly. So as you can see with 5%, so this goes back, so this has been a ceiling. This has been a ceiling for yields since about year 2000. So nearly 25 years, yields have been able to mostly be below 5%. So the risk from which I'm considering, the risk is whether this holding pattern is building the energy to punch through that 5% ceiling. This type of range that we currently have, where prices just track sideways within a fairly, when you look at the entirety of this graph, this is a compressed range, and these ranges they ultimately break and they ultimately lead to new trends. Now we don't know when the break will be, and we don't know which way it will break or how the trend would unfold, but we do know these periods they break. So if this were to break to the top side, that would probably be bad for stocks. So this is something to monitor. It's not something to act on at this point because it hasn't happened and it may not happen. Yields could break lower. But I think it's something to be aware of. And I suspect most people aren't even considering this at all. They're just looking at stocks, not thinking about bonds. But rising yields typically aren't a great thing for stocks. So let's watch, let's monitor. Let's not get too concerned at the moment, but realise it's out there and there's a key level not too far away. So coming back, just to wrap this up on the S&P 500, I think the play here for now, it's to approach this market from the long side. That's what we've been talking about in recent weeks. That remains the case now. And also looking for those opportunities that stand out. So not any old stock, they've got to meet the criteria. Rising moving averages, price above averages, they're the ones I'm looking for. Let's see how this pullback plays out. As always, I'm using those wide trailing stops to try and see off any further weakness. All right, so let's jump over to the small caps now. I've also got the small lords, the commodities. Go through your stocks, any stock codes you want me to have a look at. We'll get them up on the screen. Have a look at those charts. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. It costs you very little, and we're going to go through so much stuff. You can get involved. You can interact. You can give me stock codes. It's great. It's fun. I think you learn a lot as well. So think about doing that if you're not a strategy session member. All right. With that said, let's start with our Russell, the